Okay guys, this is the review video for the personal finance unit review. I'm going to answer the questions here. I'm going to post a second video as well going over the longer PowerPoint over the concepts too. Maybe a little bit more detail on that. So number one, what types of insurance are there? What benefits are there to buying insurance? So the 5 main types of insurance that exist are auto insurance, homeowners and renters insurance, health insurance, long-term disability insurance, and life insurance. There are other types of insurance that you can buy, but these are the most common that most people will have at some point. Okay, auto insurance covers your car if you're in an accident. There's different levels of it. Homeowners and renters. Homeowners covers both your stuff in your house and also the structure of your house if, say, a hailstorm hits or anything like that. Renter's insurance just covers your stuff if something were to happen, because the structure would be covered by the landlord or rental company that owns your apartment building. Health insurance pays for health-related expenses that you have. Long-term disability pays you a certain percentage of your income should you be injured and not able to work. Life insurance pays a beneficiary if you were to pass away. So it's typically used when people are working and they have families that are dependent upon their income. To where if they pass away, that life insurance is there to pay for that lost income. The benefit to buying insurance is that you are buying protection from expensive disasters from happening to you, right? So if a giant hailstorm hits, like it hit in Wiley a few years ago, okay, and all that damage was done to houses, homeowners insurance pays for that structural damage. Okay, same thing if you're in a car accident, right? That would be tens of thousands of dollars, depending upon the car and health costs. So having that insurance covers you for that accident. So that's the benefit. Okay, that's why you buy insurance. Yes, it costs money. Yes, it's not fun to make those payments every single month, but it's there to protect you should you run into any difficulties. Pros and cons of renting a home. Pros: less upfront costs, more mobility and freedom, no maintenance or repairs, and you can build up your credit, and you don't have to pay property taxes, right? So it's fairly inexpensive to get into an apartment. Just you have to pay a few fees, a deposit, and some other stuff, but you don't have to make like a 20% down payment like you do with buying a house. You're also more mobile because even if you sign a lease typically leases are about a year, and then there's usually ways that you can get out of your lease if you're moving or need to do anything like that. It usually just involves giving some notice to the landlord, or worst case scenario, you just pay out the rest of your lease for that time if you have to move or something like that. You don't have to worry about maintenance in most cases. Now, sometimes if you're renting a house, you might work out a deal to take care of the lawn and landscaping with the landlord. Or the landlord might say that's your responsibility, but for the most part, most people that are renting are not responsible for the maintenance or the repairs, for sure. So if something breaks, like let's say the hot water heater goes out, you don't have to pay to get that fixed. That is the landlord paying for that to happen. And no property taxes. You can build your credit if the rental company reports your payments to credit agencies. Cons of renting a home: first of all, instability in rent payment, meaning it will go up over time. Okay, so it's going to become more expensive. You also have limited options depending upon your preference of where you want to go, what neighborhood you want to live in. There might only be a couple of apartments or a couple of apartment buildings available. You also might have to move more frequently because if your rent goes up and you can't afford it, you might want to move and go somewhere else. You also are not building up any equity, meaning percentage of ownership in your apartment. That doesn't happen. All your money just goes to the landlord, okay? You're essentially paying for the right to live somewhere. All right, it's a fee. There's no tax benefits to renting. Now, pros and cons of buying a home. So, pros, you could, and most people do, build equity in their home as they live in it and make payments on it. And equity is just a percentage of the home's value that you would get were you to sell it. Okay, so if your home is worth $250,000 and you only owe $200,000 on your house, that means you have $50,000 worth of equity. So if you were to sell it, you would use $200,000 to pay off the loan and use the other $50,000 that's yours. Most people will put that into a down payment for their next house. So So you're building equity, and your credit score goes up because you're making those mortgage payments. Those are reported to credit bureaus. You also have the freedom to decorate, paint, and or make improvements or renovations to the house, which is a good thing, but it could also be a bad thing because that stuff is stressful and difficult. I know, having taken on a couple of projects during the COVID quarantine stuff, so it can be difficult and stressful, but can also improve the value of your house too, which is good, giving you more equity. Also, there's more stability because you bought the house. It provides you with a place to live, and as long as you can make the payments, you'll be fine. Your payments don't generally go up by that much either, just a little bit of tax changes every year, so that can be really helpful. And then there are potential tax benefits depending upon your tax brackets and everything else. Cons. Now, there are some cons to buying a home. So first of all, it does require a down payment and a lot of paperwork. Stressful to go through and buy. Temporary stress, but still stressful. You could lose money when you buy a house, especially if you're not in your house. If you're in your house for less than 2 years, tends to lose people money because they don't make a lot of extra payments towards their principal. They make most of those first payments are interest, and then also realtor fees and everything else. So usually, it is possible to lose money, although generally speaking, it doesn't happen as frequently as you would think. But it is possible. There are more expenses beyond the mortgage payment, right? You're maintaining the property, buying tools, paint, fixing up stuff. That's all expensive. And yeah, you're also responsible for any repairs or remodeling that has happened. What things to find if you are credit worthy? So do you pay back your debts on time plus interest? When it comes to managing your credit card debt, it is important to pay as much as you can towards the debt every single month and not simply make the minimum payment, which will mostly just go towards interest. So make sure you're making those payments back. What ways can you build your credit score? Paying your bills on time. Okay, very important, probably the most important thing you can do. Not borrowing too much, so they want your debt utilization under 30%. Not opening too many credit cards at once either, and having a long history of credit, so that takes time to do. So when you get started, you're not going to have a great or usually the best credit score, but it can get there. These things build up the credit score, okay? What responsibilities do you have as a borrower of money to pay that money back on time plus interest, okay? That is you're signing that contract, all right? Now, what is an IRA or an individual retirement account? What are the two types of IRAs? So an individual retirement account is an uninsured, meaning it can go down in value if you invest in the wrong stuff, account where you buy stocks, bonds, mutual funds, etc. The money is to be used when you retire, okay? To encourage you all to do that, the government has set up certain tax benefits to both types of IRAs that are a little bit different for each, okay? So a traditional IRA means you put the money in the account. The money you put in today is tax deferred, meaning you get to deduct that amount off you put on your taxable income today. Meaning, if you made $50,000 this year and you put $10,000 of that into a traditional IRA, you would only pay taxes on $40,000. So there is some tax benefit to doing a traditional IRA. When you withdraw the money at retirement, you then pay the taxes on it. A Roth IRA, on the other hand, means that the money you put into this account is post-tax money, meaning that you cannot deduct the amount you put in off of your income today. But the benefit to doing a Roth IRA over a traditional is that in the Roth, the money grows completely tax-free. So when you go to take that money out later, when it's worth presumably a lot more, you don't pay taxes on it. Let's see. What are investment risk versus returns, and what is portfolio diversification? So basically, when it comes to investing, the higher the risk, meaning the higher chances of you losing your money, you can usually have the potential to make more. So that's something that people consider is what is their risk tolerance? What are they willing to go up to? Some people don't want to really be risking, so they invest in really safe companies that are large, like Coca-Cola, Pepsi, Frito-Lay. All those companies are large companies that are probably not going to go out of business. It would take something catastrophic for Coca-Cola to go out of business, for example. Okay, so they will do that to protect the money, but you're also probably not going to make a ton of money or as much money investing in Coca-Cola as you would if you invested in, say, Amazon when Amazon first got started. Okay. So there is that. Portfolio diversification is simply investing in multiple different types of companies or multiple different things as a way to spread out your risk. So if one company fails, you didn't have all of your money with them, which can be really stressful because companies do fail. It does happen. And what are the 4 main types of bank accounts? Checking account is your spending account. By the way, all of these are insured accounts. I wanted to make sure you knew that. They are all insured, meaning that if the bank fails that you have this account with, then your money is guaranteed by the Federal Deposit Insurance Corporation. Savings account is usually used by people for money for intermediate expenses. A money market account it earns a slightly higher interest rate. It's just a fancier savings account. And then we have, lastly, a certificate of deposit, which is a timed savings account with a guaranteed interest rate if you promise to leave your money in that account over a certain period of time. Okay, so timed savings account is a way to think about that. And lastly, what roles do financial institutions play for citizens? They provide us with a safe place to keep our money and access to capital or loans when we need it, or credit cards, or however you want to phrase that or think about that. Okay, so if you have any questions, write them down, let me know on Monday. But hopefully that helps with the review.